Hello, everyone. This is China Gateway 360. Today, we're tackling the most critical decision for your 2026 China market entry, choosing between a WFOE and a joint venture. This one single structural choice, it basically dictates your entire risk profile. It impacts your operational speed and ultimately whether you succeed in this market. And the macro trend right now is very clear. Ministry of Commerce data shows that a massive 72% of new foreign invested enterprises in 2025 were actually WFOEs. So what's driving this? Well, foreign investors are increasingly prioritizing full autonomy and speed. They're picking that over the perceived safety of shared ownership just so they can seriously accelerate their go-to-market timelines. When we weigh these options, a WFO gives you 100% control, right? But a joint venture requires shared consensus, which honestly often just leads to operational gridlock. To put that into perspective, over 40% of all JV disputes stem from fundamental, ground-level disagreements about profit reinvestment and expansion plans.
And because time is quite literally capital in China, your setup runway really matters. A WFOE offers a pretty streamlined 8 to 12 week setup, usually with much lower professional fees. A JV, on the other hand, you're looking at extensive partner searches and heavy due diligence. That can easily drag your timeline past 6 months, basically doubling or even tripling your setup costs.
Plus, there's a serious long-term cost to that fractured control, mainly IP leakage and messy exit hurdles. Actually, 23% of all foreign-related IP litigation originates directly from JV disputes. And if that partnership goes south, exit arbitration takes an average of 18 grueling months, with legal costs often blowing past $100,000. Meanwhile, exiting a WFOE is just a standard 3 to 6 month liquidation process. So you might be wondering, why choose a JV at all? Well, the traditional promise was always immediate market access. But get this, the European Chamber of Commerce found that 58% of foreign companies report their local partners' regulatory and sales contributions completely fell short of expectations. Meanwhile, consumer goods WFOEs are out there achieving a 15% higher average profit margin just by building their own local teams, skipping the profit sharing, and keeping overhead low. To figure out your best move, let's walk through a quick 4-step playbook. First up, assess your IP exposure. If you rely on proprietary tech, a WFOE is your default, for sure. Second, check if your target sector is legally restricted from foreign ownership. Third, really evaluate if a partner is strictly necessary or if you could just hire local talent over the next 18 to 24 months. And finally, always make sure your structure guarantees a clean exit strategy. Ultimately, the verdict really just comes down to weighing risk against control. Today, a joint venture is essentially a restricted necessity, something you reserve for highly regulated sectors or strictly non-replicable assets. But for everything else, the WOFE is your absolute default for 2026. It gives you that crucial proprietary protection and the freedom to scale independently. Thanks so much for joining us, and keep relying on China Gateway 360 for your market entry intelligence.